Welcome back to part 2, merchandising. In this video we are going to walk through the journal entries for a perpetual inventory system, the purchasing transactions. So what is a perpetual inventory system? It is a continuous record of inventory and cost of goods sold. And you are probably most familiar with this system as you go to the department stores to shop, and the people at the store can look up at any given time and say how many items are in the stock. It doesn't always mean they're out on the floor, but they can look it up. Or they might say, well, the Bellevue store doesn't have it, but the Seattle store does have it. That's a perpetual system. And behind the scenes of a perpetual system, as we pull the cost components together, the initial invoice purchase will be a debit to merchandise inventory, and it will increase the inventory account. Any freight costs will also increase merchandise inventory. And then purchase returns and allowances and purchase discounts will decrease merchandise inventory. All that will go into the T account, merchandise inventory. And then when the product is sold, the inventory account will be decreased or credited, and cost of goods sold will be increased. And then periodically, you do always have to do a physical count to match what's actually in the store to what's in the computer system. So let's work through an example. Let's record the initial purchase transaction. So when companies buy, in this case the buyer is Jennifer's Office Supply and the seller is Judith's Calculator. Jennifer's Office Supply is a store, and it's stocking its store with various office supplies, and it's using Judith's Calculators as a supplier of its calculators. So they make an order, they work with a salesperson, and Judith's Calculator ships all of these calculators to Jennifer. And this is an invoice to bill Jennifer for that shipment. Now the invoice should match to what's received, and that's another internal control step that we'll talk about in a later chapter. But under the perpetual inventory system, everything goes into the merchandise inventory account of any goods they intend to sell. So if a company's buying a piece of equipment, that would go in the equipment account, not merchandise inventory. So first transaction, Jennifer's received the invoice and they will pay in 30 days. The terms are 210 net 30. So we debit the merchandise inventory account and we credit accounts payable. Debit credit to recognize the purchase of inventory. Now we have some new terms this chapter that relate to freight. Freight costs. The terms of the sale. Who pays the freight bill? Well, it depends. Companies can negotiate for the seller to pay the freight. Companies can negotiate for the buyer to pay the freight bill. And once they decide who is going to pay, the person who owns the inventory during transport will be established. So the two payment terms for freight are FOB shipping point and FOB destination. And that means at what point does title transfer? If the freight terms are FOB shipping point, title transfers at the shipping point. And then therefore the buyer owns it during transport and the buyer will pay the freight bill. FOB destination, the title transfers when it arrives at the buyer. Therefore the seller owns it during transportation and the seller owns and will pay the freight bill. This also comes into play for insurance purposes. If anything happens to the inventory during shipment, the owner in FOB shipping point, the buyer, is responsible for the damages. If FOB destination, the seller would be responsible. So let's look at this invoice. The terms are FOB shipping point. So remember, that means that the title transfers at shipping point and Jennifer will pay the freight bill. And by the way, freight bills must be paid promptly, usually within 10 days. That is just the practice in the United States. So when we book this entry, we're going to credit the cash account just for simplicity, not accounts payable. And the freight bill will not come from Judith's Calculators. It will come from the shipper, in this case UPS. So let's assume the freight bill is $140. Again, I'm not showing you a separate invoice for that freight bill. And because we're doing perpetual, we book this cost directly to the inventory account and we credit cash. Now, if the terms were FOB destination and Judith's calculators had to pay the freight bill, this would be how it would be booked on Judith's calculators. Debit to freight out, which is an expense, credit to cash. Please note this entry is not made by Jennifer's office supply, but it's just shown to demonstrate how a freight bill would be recorded if the terms were FOB destination. Finally, sometimes the goods arrived and they might be damaged, defective, inferior quality, or they just don't meet specifications. Sometimes the goods arrived and the inventory is in good condition, but the packaging looks bad, and so the customer may not want to buy it. In this case, the buyer will return the goods for a credit if the sale was made on credit, or a cash refund if the purchase was made for cash. Sometimes the seller will say, don't take the trouble to return it. We'll just give you a credit, a deduction from the purchase price. So we're going to introduce a new account, a new transaction, purchase returns. These returns will all be booked to merchandise inventory. So let's say 2 of the calculators were defective, the graphing calculators, and Jennifer's going to return them for $65 each for a total of $130. We debit accounts payable, so Jennifer is saying, I'm not paying this, so I'm reducing my payable, and I'm also reducing my asset account inventory. I'm taking them out of inventory. I'm returning them to the seller. Lastly, when it's time to pay the bill, you will go back and look at that invoice again and say, what were the payment terms? And as I previously said, in this case, they're $210 net $30. So what this means is the buyer gets a 2% cash discount if the payment is made within 10 days. Otherwise, the full amount is due in 30 days. I know we have that term here, net, which suggests that we're not paying the full amount, but that's just the way that the terms read. $210, otherwise full amount due in 30 days. So why would a buyer want to take a cash discount? The purchaser saves a lot of money if they have the cash flow to pay the bill early. And the seller gets their money faster. There's lots of other payment terms that you can read about. You can Google payment terms. This is a typical one in retail, 110 EOM, N10 EON. So let's look. Before we get to paying this bill, let's take another look at the accounts payable account. The original invoice was for $1,400. But Jennifer returned $130 for the 2 calculators. So Jennifer only owes $1,270. And that is what she will apply her 2% discount to. So we clear out accounts payable for the full amount. We take that 2% discount against the inventory account, and we credit cash for the balance. So you can see Jennifer's paying less than the $1,270 because she gets that discount. If Jennifer chose not to take the discount, 30 days she will pay the full amount of the bill. Again, this is a demonstration of what would be recorded, but I'm going to stay with my original transaction. So the question is, should you take a discount? Yes. A 2% discount not taken is money lost. It means that the company effectively is borrowing that money for 20 days, which annualizes to 36.5%. So you should always take a discount if you can afford it and if you have the cash. So what's the final cost of this purchase? We had the purchase price, the additional freight, the return, and the discount. So it totals up to $1,385. This is the end of part 2. Our next video will be Perpetual Inventory Journal Entries, the sales side of the transactions.